Bob Iger brings back Dividend and more. Why the Marvels doesn't represent the future of Walt Disney Company DIS stock analysis. Well, by nature, I am a born experimenter to this day. I don't believe in sequels. I have to move on to new things. There are many new worlds to conquer. As a matter of fact, people have been asking us to make sequels ever since Mickey Mouse first became a star. We didn't make the same mistake with Snow White when it was a huge hit. The shot went up for more dwarfs, top dwarfs with dwarfs. Why try? We never will. Perhaps there'll be other ventures with equal critical and financial success. But we know we cannot hit a home run with the bases loaded every time we go to the plate. We also know the only way we can even get to first base is by constantly going about it and continuing to swing. This is from Walt Disney, the founder himself, an innovator, a true entertainer. Bob Iger, as promised, he has finally brought back our dividend cash money and more of this. Not the Marvels sequels. Why the Marvels doesn't represent the future of the Walt Disney Company. I will explain DIS stock analysis right after this.
How you like that? How you like that? Nah. Look at you, now look at me. Look at you.
Disney remains Netflix's one true competitor in long-form video streaming and is taking giant steps towards profitability in its direct-to-consumer businesses. The company's international parks and cruise lines have also resumed full operations after pandemic closures and are posting strong results. At the same time, Disney faces a very uncertain macroeconomic environment that is weighing on ad revenue and has been begun to impact domestic park attendance. With the return of Bob Iger as CEO, Disney is working to lower investment in its DTC business and to focus on the most profitable content. Mr. Iger has made a number of strategic decisions. These include pursuing profitability at DTC at the expense of subscriber acquisitions, opening key asset ESPN to a potential co-owner or minority strategic partner, and evaluating the possible divestiture of Disney broadcast and cable channels. The art of making a movie. 1 year after returning to the helm of Disney, Bob Iger said his number one priority is to help the studio in turn around creatively, meaning tell better stories, create more entertainment, not just sending some messages. The experience of accessing the films and watching them in the home is better than it ever has been. And it's a bargain when you think about it. Streaming Disney Plus, you can get for $7 a month. That's a lot cheaper than taking your whole family to the movies. So I think the bar is now raised in terms of quality. And it's about to get people out of their homes and into the movie theaters. Quality has been an issue for Disney since it's launched its streaming service in late 2019. And increasing its output to feed Disney Plus, Iger said the company diluted its quality. The Marvels was shot during the COVID, he explained. There wasn't as much supervision on the set. So where they had the executives that are really looking over what's being done day after day. And that was a result mostly of COVID. But at the same time, we increased our output tremendously to feed the streaming platforms. Too much. And that's a mistake for us. And Marvel suffered greatly. Quantity has diluted quality at Disney. Disney's fiscal fourth quarter displayed the firm's financial might and why we think shares remain undervalued despite challenges it faces. Most notably, the firm has cut costs significantly, sending free cash flow skyrocketing. However, TV-related struggles continue. And the headline grabbing 7 million streaming subscriber additions featured only minimal growth domestically. We question how successfully Disney can funnel its declining linear business straight into its direct-to-consumer streaming offerings. But with such valuable franchises and levers to pull, we feel the market is too pessimistic. Profits and free cash flow were the stories of the quarter. In our view, total segment operating income was up 86% year over year, driven mostly by the experiences segment, and a $1 billion improvement in DTC losses. The firm still expects streaming services to reach profitability by the fourth quarter of fiscal 2024. Firm-wide, Disney is on track to reach $7.5 billion in annual cost reduction by 2024. Despite planning to increase capital spending by about $1 billion, the firm expects $8 billion in free cash flow in 2024 from about $5 billion in 2023. Apart from experiences, sales growth was not compelling. Fourth quarter entertainment revenue grew 2% year over year, with 12% DTC growth more than offsetting a 9% decline in linear networks and sales and a slight decline in content sales and licensing. As has been the case with peers, linear networks advertising was weak. However, affiliate revenue was also down despite higher rates. And we don't see opportunity for significant improvement in either of these revenue streams as long as paid TV subscribers and linear viewership continue declining. Sales growth in DTC was almost entirely due to a jump in internal subscribers, as average revenue per subscriber was little changed across the services. And subscriber bases for domestic Disney Plus have been flat over the past year. We believe that Disney is successfully transforming its business to deal with the ongoing evolution of the media industry. The firm's direct-to-consumer efforts, Disney's Plus, Holster, Hulu, and ESPN Plus are taking over as the drivers of the long-term growth as the firm transitions to a streaming future. Disney's other components rely on the world-class Disney brand, sought after by children and trusted by the parents. Over the past decade, Disney has demonstrated its ability to monetize its characters and franchises across multiple platforms: home video, merchandising, themes parks, even musicals, la 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 la. This stable of animated franchises will continue to grow as more movies get released by the animated studio and Pixar. Disney also has arranged the Marvel Universe to create a series of interconnected films and product tie-ins. With the acquisition of Lucasfilm, and the film has positioned the Star Wars franchise in the same manner, Disney's theme parks and resorts are almost impossible to replicate, especially considering the tie-ins with its franchises and other business lines. We expect Iger to focus on fixing the customer complaints that have arisen since the reopening. Bullish points. The parks and resorts segment will rebound strongly from the pandemic as families still view the parks as a prime vacation destination. Disney Plus has a long runway for growth available in both the US and internationally. The firm's original series and the deep and constantly expanding library will drive the growth, Although making movies is a hit or miss business, Disney's popular franchises and characters reduce this volatility over time. Additionally, the firm's annual slate does not generally rely on a big picture, reducing the downside from the flop. We assigned Walt Disney a wide economic moat. Its media networks segment and collection of Disney branded businesses have demonstrated strong pricing power in the past decade. We believe Disney branded businesses have demonstrated strong pricing power in the past decade. We believe that the addition of the Fox Entertainment assets will continue to help the firm generate excess returns on capital despite operating an increasingly competitive media marketplace, including within the streaming landscape. Despite changes in consumer behavior, pay television penetration remains above 60% of U.S. households. The Disney networks remains important pieces in the traditional pay TV bundle. While cord cutting remains an ongoing issue, premier cable networks including ESPN and FX still generate significant cash flows from both affiliate fees and advertising. With the price increases historically outpacing customer losses, while we expect the pay TV subscribers to continue to decline annually, the underlying networks remain profitable, and the cash generated will continue to be reallocated to support the direct-to-consumer efforts at Disney. Disney also owns ABC, one of 4 major U.S. national broadcast networks, and affiliated TV stations in 8 markets, including 6 of the top 10 markets. While network ratings have declined over the past 2 decades, broadcast networks remain the only outlet to reach almost all of the 120 million households in the U.S. Network ratings still outpace cable ratings and provide advertisers with one of the only remaining methods for quickly reaching a large number of consumers all at once. The media network component also includes the Disney Channel, one of the 2 dominant cable networks for children, which allows Disney to introduce and extend its strong content portfolio. Disney now has 6 studios: Marvel, Pixar, Lucasfilms, Disney Animation, Disney Live Action, and 20th Century. With the ability to generate blockbuster films annually, with the addition of Fox, Disney now owns 14 of the top 20 films in terms of worldwide box office grosses, with 10 of these movies released since 2015. All of this content now finds its way into Disney Plus or Hulu, strengthening the platform's competitive positioning within the streaming landscape. Our updated $145 value estimate for Disney reflects slower subscriber growth and lower losses from streaming. We expect average annual top-line growth of 6% through fiscal 2027. We now project losses for the streaming segment to continue through fiscal 2024. That's why we think shares remain undervalued despite challenges it faces. A cash dividend of 30 cents per share in the second half of the fiscal year of 2023, payable January 10, 2024. Are you interested or not? Let me know.